Hi, I'm Kevin French from Core Wealth. We are going to be talking about the month of April 2025, and it was quite a hairy month in financial markets. Liberation Day was the 2nd of April, and we saw Donald Trump come out and announce a 10% tariff on all imports into the US and further additional tariffs depending on the relationship with the country involved. This was the start of really tumultuous reactions by the markets as it tried to digest whether companies were going to make more or less profits and what the impact was going to be on the economy and a number of things. And then we saw through the rest of April announcements being made that tariffs were being imposed, and then reaction to that by the country, reaction to that by Donald Trump, and so the month was a really tumultuous one. Looking through that noise, companies actually made some good profits in America, those that were announcing profits, but they would not give direction on what they expected into the future because of the uncertainty around these tariffs, as you could understand. Other things that happened during the month was that we saw emerging markets actually did quite well. You'll see in the numbers shortly. China, though, bore the brunt of this uncertainty because of the high tariffs that were being imposed there. At the time of recording now in early May, we are seeing some discussions being held between China and America, and it looks like that could be resolved as well. The bond market in the US was again quite reactive with concerns as to whether these tariffs are going to cause inflation or not. And so we saw that market also moving up and down quite a lot, but generally bond yields in America now healthily north of 4%. And lastly, on the oil price, we've seen the oil price coming down as OPEC, which controls the oil market, most of it globally in terms of supply, has agreed to increase supply. And so the Brent crude price is closer to $60 a barrel, where if you think, less than a year ago, that was up closer to 80. The South African equity market was a very good example of how this volatility feeds through when there's uncertainty. We ended the month at Johannesburg Stock Exchange up 4.3%, but at one stage during the month it was down 14%, so huge swings. And that came on the back of some more certainty coming after Trump had imposed tariffs, saying that he would give countries 90 days to negotiate a trade deal. But on the other side, the South African government kept scoring own goals. We'd already had our ambassador kicked out of Washington. A new ambassador, Mcebisi Jonas, who has a good track record in public finances in South Africa, was appointed, but he had also made some remarks that raise a question as to how well he'll be received in Washington. On the South African budget side, April was an absolute dog show, with eventually the budget being pushed through with a VAT increase through the help of some of the smaller opposition parties. The Democratic Alliance took the process to court, and it looked like it was going to be halted by the courts, but before the court ruling was made, the ANC backed down on it. So too many own goals, but at the end of the day, April actually wasn't such a bad month. So we've just spoken about how volatile it was intra-month, but have a look at these numbers which show you how the months actually ended. And not too bad actually. April, a lot of green in April. Developed market equity at 0.9%, despite the US equity markets only ending up being 0.7% down, but at one stage was looking much worse than that. Emerging markets, again, up 1.3%, even though the biggest emerging market being China was down 3% for the month. Japan also had a really strong month, up over 6%, catching up some of the underperformance that we'd seen so far year to date. The big winners were the European markets as well as listed property companies globally, and bonds actually also doing quite nicely for the month. If we have a look over the longer periods of time, Europe and UK definitely the places to have been over the last year, and even to some degree over the last 3 years. So what we've seen over the last year or so now is it's not just been the US equity market that's been driving global markets. We've seen other markets really picking up, and this just emphasizes the benefit of having a diversified portfolio and not just being focused on one market. So if we have a look at the South African market, even though it was very tumultuous during the month, we can see a lot of green for the month of April. And so equity markets up 4.3, listed property up 7.6. Although it's showing as green, it means that the hard currency, the US dollar, the pound or the euro were actually strengthening. And that was a lot on the back of just all the uncertainty, the tariffs on the one hand, and then all the own goals I spoke about earlier. But if we have a look at both year to date and especially over the last year, the listed equity market, the JSE, up almost 25%, listed property up almost 30% for the year, and even bonds up over 19% for the last year. So it's been really a good year over the last year, and that has fed through into the last 5 years, but just showing that we've really seen our markets improving over the last 5 years. Equities up 17%, listed property up 19%, and the All Bond Index up 11%. When we look at the South African models, those are feeding through into the 5-year numbers now quite nicely. So for South African or Rand investors, and remember the way the table works, if it's in green, that means we've outperformed our peer groups. If it's red, we've underperformed. And lots of green on the slide. And what I'd like to do is just touch on the 1-year numbers. We can see that we've seen some significant outperformance by a number of our strategies, particularly our Core Wealth Income strategy, and just showing you that if this would be a place to rather invest in than sitting in, definitely in cash in the bank or in money market funds themselves. Over the last year, you've earned an additional 4.4% over money market averages. All of our strategies outperforming, but worth noting is our retirement growth strategy, some 2.8% ahead of its peer group over the last year. And then our recurring income growth and defensive strategies, and this is on the back of having a portion of that invested in listed property, have also outperformed their peer groups by over 2%. So looking at the 5-year numbers and picking up on the comment made on the markets as to how equity markets have improved over the last 5 years, you can see all the multi-strategy or multi-asset strategies healthily into double digits and healthily ahead of their peer groups. So our retirement growth strategy over 3% ahead of the class average, our flexible strategy over 2.5%, and RI growth over 2% ahead. So seeing some good outperformance on the back of how we've positioned and how well our managers have done. So having a look at how our global strategies did, we'll first look at the global strategies that are pound denominated, and we can see here that our balanced strategy over the last year has actually underperformed its peer group, and this has been because we typically don't hold much in the way of US bonds there, and that has just been a bit of a drag on performance. But over the longer term, and these strategies are our newest strategies, everything's still outperforming the peer groups. And then if we go on and have a look at our US dollar strategies, so again, global strategies similar to the sterling ones, except they are denominated in dollars, and so we're investing in US dollar bonds and US dollar cash. And we can see here, probably what's most exciting to see is the level of outperformance that we've seen over the last year ahead of peer groups. So some healthy returns there. And if we have a look at since inception, and these strategies have been running now, this is their 9th year, some consistent outperformance of the peer groups over the longer term. So volatility is one of the ways to identify if the market is nervous. The volatility index that we're showing in this slide just shows you the 3 most extreme points that it ever got to. One was during COVID, as was understandable. No one knew how this thing was going to unfold. The other one was the global financial crisis back in 2008. And again, extreme circumstance was the second worst period. But the uncertainty that followed the tariff announcements after Liberation Day was actually the 3rd highest period that this index got to. So just showing how much uncertainty there was in the market. Something seems to have changed recently. This graph just shows us currency, which is the blue line, the euro versus the dollar. And then the green line just shows you short-dated bonds in Germany minus the short-dated bonds in the US. And typically what happens is that as the bond markets move, the currencies move in unison with that, and hence the 2 lines following one another. But what we've seen of late is that this unusual movement suggests that investors are losing some confidence in the US bonds, and they could be shifting their money to European assets or bonds, and that has weakened the dollar beyond what the market had predicted. Part of understanding markets is trying to understand what the different decision makers who buy into the markets are doing. This survey just shows you what different asset managers have done most recently, and the graph on the left just shows what asset managers are thinking. And If the bars are above the line, then the managers are overweight US equities. If they're under the line, that means they're underweight. And we've seen in the last sort of 2-3 months up to April this year that managers have changed their views and are talking about being underweight the US equity market later into this year. And where is some of that money gone? On the right hand side, it just shows you what has been happening in terms of flows into the gold market. Gold is often a place where investors will flee to for safety. And when there's uncertainty, we've seen that happening of late, and that's why the gold price has also been going up quite a lot. So you'll know if you've watched this at all that we pay attention to valuations. Are shares or assets that we're going to buy cheap or expensive? We'd rather buy them at a cheaper price than an expensive price. And the US equity markets have been expensive, and that's what the slide shows, that previously on a forward price earnings ratio, well over 22 times, getting close to 23 times, which is high. You can see it relative to its own history going back 20 years. In the last couple of months, and particularly in April, we've seen that drop significantly, and now it's actually within one standard deviation of its long-term average. So a much more comfortable picture, but the uncertainty around future earnings still needs to play out. So is it time to be greedy or not? I just want to pull out two things from this slide. The first one is, if you have a reasonably long period of time, the probability of losing money gets much, much lower. If you are just invested over a day, there's almost a 50% chance that you'll lose money. However, if you are thinking about investing over the next 5 years, there's only a 10%, a 1 in 10 chance that you could lose money. Or put differently, there's a 9 in 10 chance that you'll make money over that period of time. The second table here just looks at the benefit of being in the market. If you're trying to job the market in the short term, it's very difficult because markets can move so quickly and so rapidly. And that table just shows that different decades over the last 80 years, what returns you got if you just stayed in the market. You didn't try to find the good days or the bad days, you just stayed in the markets. And you can see that price return column giving some significant returns. And that's really what we're about at Core Wealth. So we started this video by talking about when to be fearful or when to be greedy. And that quote actually comes from Warren Buffett. And he's got this quote that you can see on the slide. I'll tell you how to become rich. Close the doors. In other words, get rid of distractions. Be fearful when others are greedy, and be greedy when others are fearful. One of the main things we're trying to do with you as our clients is ensure that you don't get fearful when you should be greedy, and vice versa. Don't get greedy when you should be fearful. And that's really looking through the noise, which we have the benefit of seeing a lot of research and analysis, and that helps us help you make good decisions.